I know you've said in the past that liquidity keeps you up at night. What can Amundi do to mitigate that risk?
Actually, at the fund level, you must service liquidity at any time when you are a daily liquidity fund. But all assets are not liquid at any time. Some are rarely liquid, and others, and this is where lies the problem, are sometimes less liquid than expected. This is where the problem lies, actually. Following the crisis, we've seen banks retreating back from market-making operations, and therefore market liquidity has deteriorated at a time when we've seen a frantic search for yield in various types of funds. So this creates the framework from potentially liquidity mismatches.
What does that actually mean on how you can protect yourself? So have we learned anything? Have asset managers learned anything from Woodford and the blow up in H2O?
Actually, the problem is taken seriously. People are aware now that we are living in a world of excess liquidity in the macro sense, but deteriorating liquidity in the micro sense at the market level. There is no one-size-fits-all type of approach. There is a toolbox, including credit lines, swing pricing policies, gates, dynamic liquidity buffer management, and regulators have stepped in to enforce some regulatory framework.
What do you see in the markets in the next 12 months? Do you worry about earnings? Do you worry about a correction in equities?
Yeah, my view is that too much is expected from policy mixes, generally speaking, both the monetary and the budgetary sides of the equation, at a time when fears about global recessions are overdone, in my view. So there is room for disappointment short term on both the bond side and the equity side, or the risky asset side, specifically at a time when the earnings season is likely to be on the weakish side.
Do you see any asset bubbles being created, asset bubbles that could actually burst?
Actually, you know, bubbles are recognized ex post when they burst, actually.
But you have to try and see them before they burst.
What I think is that we live, and we will be living with core bond yields at extremely low level for some time at equilibrium. It means that the only game in town is to pick yield somewhere in the system. Given that core bond yields are low at equilibrium, it can justify higher valuations at equilibrium in the risky asset space, with some limits, obviously. There are some segments in the market really hot.
But does that mean that it's pushing people to take unwarranted risk? How bad is the search for yield, and what does that do to distort markets?
Okay, you've got no choice but trying to pick yield somewhere in the system, but at the same time we are probably close to not an end of the cycle, but probably a maturing sequence in the cycle where actually your main risk is to build to pile up risk premia on future fat tails, actually. So piling up risk premia on future fat tails is basically fake alpha, in my view. So this is your risk. So selectivity and focus in the portfolios are critical at this point.
What do asset managers get wrong about the economy? What do markets get wrong about the economy? You say that the risks of recession are overdone. What does that mean for where you would put your money?
Actually, we think that risks are overdone because there is a clearly sharp slowdown on the manufacturing side of the global economy, but the consumer side of the equation is holding well, and services as well for the moment. This is underestimated in my view. As a consequence, we've seen investors basically pricing into recessionary risk, typically across the curves, across the defensive sectors, across bond proxies. At the same time, you've got areas like cyclicals in Europe, where you can pick quality stocks in the cyclical sector priced for the worst.
Will volatility come back to the markets?
Actually, volatility has been constrained by carry type of strategies. They are sellers of volatility. So volatility has been constrained, and as a consequence, we can see short squeeze or risk gaps with more low volatility and more high volatility. Averages don't matter. In this current regime of volatility, you've got skewness and more low, more high volatility. This has been, on top of that, we've seen the action of risk parity, CTAs, CPPIs, target volatility funds adding to this pattern of volatility. So going forward, I wouldn't be surprised at all to see a jump at some point of volatility. But volatility can be played or bought as an asset class, because it's a disease, but it's also
an opportunity.
It is also a remedy.
Is Brexit an opportunity after the news from today?
Short term, we've got a relief. We've got a bird. It's not sure that the bird will fly. It's a long journey going through the UK politics. For an investor, medium term, the question is looking at risk premium. Am I well remunerated for the risk of further depreciation of the pound? And the answer is still no.